Hello guys, glad to have you on board again. Today we're going to do the weekly close podcast, and there is not so much I could tell regarding Bitcoin or Ethereum. All I will stand for is that the 4-hour chart time frames on Bitcoin seems to be the most reliable one to me. We're testing and attempting something in here. Hard to say if this is going to be pulling through, but what I can see in here is a potential breakout structure in the 4-hour context. Let's put that in perspective. Remember how to identify the general structures. And if I would have asked you a question, and by the way, this is typically the kind of questions I'm going to ask you guys in the monthly multiple choice question test I'm going to give you guys. Once again, a reminder, those who will answer this correctly, I don't even have chosen if this is going to be 10 or 20 questions. It will depend on how much time I've got to pull into this, but let's say it's going to be a 10 question. If you answer the 10 questions right, you're just going to have a 3 months of your indicator, and obviously the next month you'll have another test, and if you pull through as well on this one, 3 months as well, which means you can have 3 indicators if you just got it right with applying the strategy. I'm not gonna just put very hard questions in there just to push you to fail. I will do just normal questions just like this one. What is this context and maturity? I will give you multiple options, like this is a range, this is a potential trend breakout, this is a potential trend accumulation, and it's up to you to answer, and there's obviously just one answer in here. I would say applying the strategy, the current context is a trend accumulation structure heading toward potential breakout, and what we have in here, the latest candle, could be leading to the breakout. Doesn't mean it's going to happen, but this, if it holds the candle close in 22 minutes, and if another candle closes on top of the bearish context, to me, it is going to be a valid breakout to trade, which means we could finally get the hell out of here with the Bitcoins, and probably other assets will follow as well. It's hard to say. Still, we have 21 minutes to go in here, and we need to go further than that. We need to close out of the context with a breakout candle, which means a candle that closes at the highs and no upper shadows. All right? So how, once again, just we're going to apply the usual technicals. How do you make the difference between accumulation and all of the steps? Accumulation must be done with higher lows. This is what we've got in here. All right, we've got in here higher major lows, and you need to see prices reaching out the resistant context, pulling back to trend channel, and the trend channel must be rapidly rejecting prices anytime it got tested and push price back to context every time. So it is context trend channel, context trend channel, context, until bang, you've got the breakout in which price will break both the trend channel and the context. All right? So in here, the current state of this market is accumulation heading toward breakout. That doesn't mean it's going to happen, but that's what's the most probable in here. So we're mature ranging, we've got higher lows, therefore applying the strategy in here, you must head toward a breakout. The next step for the breakout is to have a sine wave breakout, which we currently are plotting in the chart, but we need to have the breakout candle. It is heading toward this breakout, but we're still pending. Therefore, I still recommend a little bit of cautiousness, but I need to be honest. To me, we're doing everything we need. We're breaking the trend line. We can clearly see what's been breaking. You've got the stop hunting structure in here. The market is pushing rapidly through this. We've got a strong bullish momentum. Everything suggests the breakout is going to occur. So it's still a little bit too early to say that, but probably 20 minutes from now, it's going to be pretty much valid. So I would say if you do take that breakout, how do you trade that according to the strategy? You take the breakout trade. All right, so it's a bullish breakout in here. You put the stop loss out of the previous low, so you put a stop loss in here, and normally you're just fine. It isn't that big of a risk. I mean, I would say in here, and I stand for what I say. Once again, I rarely give you real-time trades, but I think in here there is something to trade. It's a 6% stop loss to target for a 15% gain, or even you can, I think the minimum is to go 5K in here, so it's an 18% potential gain. I would suggest if you get in here, just put the stop at break even at halfway through. So if we reach out, let's say 4,600, this is where you can rise your stop losses. But I would say if this closes like that, and if you do have the sine wave target, in my opinion, my personal opinion, I think it's viable to take that breakout. But the candle needs to close out of context, which is currently not doing. But I think we're heading toward a breakout. So watch out for this in the following hours. It definitely is something interesting to be played if this is pushing through. But if this is just unwinding or closing below the 50% of this candle, this is just not working, all right? So don't be overexcited. Once again, wait for confirmation when it comes to breakout. I mean, buying in here or buying in here doesn't make a big difference. It's just how much risk you're accepting to take, all right, in that perspective. Now regarding the stock market, we're going to go straight to this. I'm not going to make the weekly close show today because we really need to have those weekly candles closing, and we're hardly hesitating at that point. We can have so many options for this weekly close. I mean, look at how it looks like just right now. Even though we've been breaking the lows and still trading far lower than the previous highs, could be a positive weekly candle close, and probably even the highest ones of that year. So it's hard to say. It's pretty damn hard to figure this out because things can pretty well change until then, as we're trading in a narrow 1% range, which means just a 1% day can change the entire price structures of that weekly candle close. So it's hard to say, and moreover, we're going to have 1 hour future charge trading right after the cash closing, and this is where I think everything might be at play. When the cash will close, I think the last hour that precedes the futures market closing may be the game changer. So we could just have an entirely up day and closing the week at the high from the SPX, so closing the cash as high as possible, but still the final hour for the futures contract can be just surging to the downside and losing 0.5% until then. So we're going to try contextualizing intraday trades, because I'm definitely going to trade today. On my swing scenarios, I'm going to take a first reinforcement out of the SPX. Not a big reinforcement. Once again, I'm already maximum leverage, but I'm probably going to take an additional 0.5 or 1% risk. Even if that means increasing the underlying loss if it shows up, it's going to be a separate trade. It's going to be an intraday trade that I'll probably secure fastly and maintain the remaining leverage as an addition to my swing positions, but only if the trades can be secured on an intraday basis. If I can't, I'll put it out not to handle overweek risk on top of the ones I already take. So this is what's happening right now. Okay, my average price is in here, and I'm probably going to have to take a 20% reinforcement just on an intraday trades, but I'm obviously going to secure this and keep the remaining leverage to just rise this average price once a bit. All right. So what I'm going to be doing, and I think this is what is the most easy to trade. So if we do have a look at the SPX, the 1 hour chart time frame still hasn't fucking reversed, but it is still very much doing the same old stuff. Look at that. Trend channel's reversing, trend channel might be reversing in the following hours, and every time we've been doing context to context. Okay, so it is a potential price accumulation. It isn't yet valid, it is just pending. So this one, I would say, this is what I'm going to be trading, but that doesn't mean it is one battle. We need to manage the risk for that, which means if you do take the trades I'm going to talk about, it is an absolute stop loss at the market top. We must not go there. It's impossible. If we go there, it means this scenario isn't working. All right, those who are low risk profile will wait for the price rejecting in this area and wait for the breakout to occur. Just like we saw on the Bitcoin, we must go back to support area, support context, and break through this in the meantime as breaking the trend channel. Both channels must be broken in the same time with candle accelerating, volume pushing up, and sine wave breakouts. All right, so for now we're pretty far from this, so all we can trade is a potential accumulation. How do you do this? Remember that The trend channel in here is the lower time frame context. So I suggest trading the 15-minute context today is definitely what needs to be done. Yesterday was just a divergent structure, no more than that. And to be honest, the divergence wasn't clearly visible on the RSI. So today we're pushing a step further and still no signal as we're talking. So I'm waiting for that goddamn 15-minute signal, knowing that this is hard to say what the hell is this. I can't really say what structure this is. Is this a double bottom? Because it really feels like it is. It is a higher bottom because it's basically just a few points to be a same price. So I could consider this a double bottom, and in that perspective, the failing price must be near the previous stop, which we're currently trading, which we mean, let's put it straightforward. What it means is that I don't know if I'm going to take a signal in this area or if I want prices to overcome this area, as we do have a slightly higher low than this one. To me, it's really it's subjective, it's subjective. So you can take whatever you want. You can say this is a double bottom and therefore we should fail near the previous stop and kind of a flat consolidation to just prepare for breakout. Or this is just a tiny higher low, but still a higher low that will require a higher high in here. And in that perspective, we need to wait for this to be broken up to trigger the signal. So it's up to you. It's a choice. I can't give you mine because I'm not able to do one. All I can tell you is that near this price is where I'm going to trade today. We're already there, still have no signals. So I'm just going to wait for a signal. I'm going to obviously, as this is a range trade, wait for a goddamn triangle. All right, so in here, I'm waiting for the triangle to show up. And I'm waiting for a signal to have preceded it. All right, so that's all I'm going to be doing. This signal may be coming in the next 15 minutes or in the next few hours. I think this is going to be done by today, and I'm going to take that trade. I'm going to take a 1% risk with a stop loss in here. So I'm going to put my stop loss at 28.52, and I'm taking a 1% risk. So depending on the price I will take, it's probably going to be a leverage one intraday trade, and I will obviously pay for my stop loss by the end of the day. All right, which means if we sell in here and pushes down here, I'm going to take 50% gain and just let the rest of that sizing position to the average weekly and monthly scenario leverage I have in. All right, so just to set things real straight, it's an intraday trade that I'm taking aside from the rest. I'm totally aware that if the market just fucks me up, triggers a signal, and goes straight line to close at the high, I will take 1% additional loss to what I already have forecasted to take if the market decides to invalidate me on these weekly scenarios. But we're also going to talk about something really, really important now, something I just made a show about that. I'll do it probably on TradingView, and I invite you guys to have a look at this. We're going to talk about the reversed yield curve because we've got some really important stuff to talk about, suggesting we might be peaking the market in here once and for all. And it is just, I think right now, the best risk assessment, the best economists are definitely the bond traders, and the bond traders have given a very dangerous signal since Monday. But we're going to talk about that on TradingView specific, so everyone can benefit from those informations. So for today, it's going to be it. I'm going to give you my informations up at candle closes, so I may be eventually doing another show later today. I think the dollar is also about to reverse once and for all after pissing me off for quite some time in this area. I've been taking my trade in here, if my memory's right, or close to this area. I'm waiting for this goddamn dollar to fall like shit to terminate this week with an upper shadow candle, and hopefully by this time we'll be able to finally goddamn trend in the forthcoming weeks, and to have both a dollar failing, yields pulling up, pushing back up, stock market falling like shit, heading toward higher volatility to come next week. For now, we're on volatility support, but I'm expecting next week to start bringing up this volatility to break up the 18.4 previous highs, probably to just die in the 20 area. I don't expect the market to just fall apart next week, but just to keep on pushing lower, rising the pressure as we head toward May, which is probably going to be a bad month for equities. So you must know that today we're not even just playing the weekly candle closes, we're also playing monthly and quarterly closes. All right, so let's have a quick look at what this will look like for the SPX. Bulls must be so happy. No one ever imagined this would happen, but that doesn't even mean we neutralized what happened last week, because last quarter was a strong bearish engulfing closing at the lows. This is just, we're testing if we're really bearish. So next quarter is going to show up pretty interesting things. We could do another inside bar, which means we could even not break the 24.53, even not breaking the 28.60 by the next quarter. All right, could be very well probable. So don't be over bearish. Remember that what we have in the yield curve inversions doesn't mean we're going to have recession right away. Recession can take up to 3 to 12 months to show up in the current context and my current estimations, which are still estimations, so you don't take that for granted. And even if that happens in this time scale, then it means don't expect the market to just fall by tomorrow, because the market will now wait for additional information that the recession is really pricing in. All right? So the worst is going to come when the recession will be there, because there will be no hope and we'll just have to destroy valuation. But in between, there's going to be a sideways action, kind of hesitating before going fully in. But anyway, my job is to anticipate the market top. I strongly think we have it, and it's just a matter of time. Just having a look at the weekly volumes as well. Rising significant questions. Last week was a high volume, and this week has been as well. And this week has been kind of confirming what's happened last week. We've been breaking the lows and maintaining the highs. So even if this is a weekly candle positive close, it still shows up red flags for the bulls. And I need to say that, I mean, when you have bearish candles, when you have volumes, when you have bearish reversals, that doesn't mean we're going to go straight line bearish, but it all says that the bull run is over, and we still have, as for now, a lower high on the weekly charts with a lower low, which means if we do go bearish and build a top in here and confirm that in the forthcoming weeks, we're going to have a bearish weekly momentum, which is the worst case scenario. And if we do have a recession looming in the between and having some deterioration in the housing market, in the job market, it will just push prices even lower. So I'm expecting this to show up. The bond traders are expecting this to show up as they're pricing the short-term bonds higher than lower than they do price the long-term bonds. So this is not a good news. I'm sorry to say that. I know most people don't want this to happen, but still it's happening, and you have to play by the rules. And those rules says the recession is looming, and it is not even a question right now.